Good morning and welcome back to Morning Markets from True Potential. Paul Duran's Investment Director. Today we'll start by just looking at stock market returns. We saw very strong returns from the US market yesterday, up 1.4% as the market rallied towards the end of the day. We saw a little bit of weakness here in the UK and over in Europe, down 0.4%. Material sector, highly cyclical sector, showing particular weakness as investors still concerned about the pace of economic growth, interest rates and inflation. This morning, all eyes were on UK employment data, really important because employment has been very tight or very strong within the UK, and that really helps support economic growth, but it also means that wages have been increasing, and that allows people to afford the higher prices and high inflation that there is today. The numbers this morning showed that the UK labour market is still very tight, very strong, which is good news, despite the unemployment rate increasing from 3.6% to 3.7%, which was in line with what was expected. The number of people added to the workforce increased by 27,000 as older people that had retired have actually come back into the labour force as to help cope with the higher prices that they have for goods and services. In terms of the number of people in terms of job vacancies that are out there, that declined for a fifth consecutive month. However, it still remains very, very high at just under 1.2 million. In terms of wages, if we exclude bonuses, that came in at 6.1%, which is higher, much higher than the expected 5.9% and the previous reading of 5.7%. So people are getting paid more, which is good news. However, that's inconsistent with the inflation target that the Bank of England has at 6.1%. Wage growth is still very, very strong, and that will help support higher inflation for longer. If we include bonuses, that also was in at 6.1%. So wage growth still very strong, and we'll hear from the Bank of England on Thursday, and they're expected to increase interest rates by 0.5%. So we'll watch out for that, and we'll keep you up to date. Elsewhere, today, big day for the US in terms of economic data. We get inflation data again. Last month, there was a positive surprise for US inflation, coming in below expectations. When I look at the numbers, we have headline inflation last month came in at 7.7% versus 8% expected. And when we strip out those volatile components such as food and energy, we also saw inflation drop from 6.6% to 6.3%. And that really did help support equity markets and bond markets throughout the course of November. We saw very strong returns from both asset classes. So today, if we get a similar reading where inflation comes in below analyst expectations and continues to show that inflation is trending down, and that the interest rate hikes that the Federal Reserve, the US Central Bank, has put through this year is helping to bring demand and supply back into better balance, that will be a real positive for markets again, and we'd expect equities and bonds both to rally on the back of it. So we'll keep you up to date and tune in tomorrow for an update on US inflation. But that's everything from us today. Thank you for listening, and we'll see you tomorrow.
If you're interested in taking your investing to the next level, or would like to know more about the options available to you when you retire, then download our free guides to ISAs and pensions. These are available in the video description below.